Hi everyone, welcome to my channel where I talk about all things related to gold and precious metals. In today's video, I'm going to give you an update on the gold price, which has been holding steady just below a 1-month peak touched on Thursday. I'll also explain the main factors that are driving the gold price and what to expect in the near future. So, let's get started. As you can see on the daily chart, gold price confirmed an upside break from a symmetrical triangle on Thursday after closing above the $2,034 key resistance. This is a bullish signal that indicates that the buyers have gained the upper hand and are ready to push the price higher. The 14-day Relative Strength Index, RSI, is holding comfortably above the midline, suggesting that there is more room for the upside. The immediate resistance is now seen at the 4-week high of $2,051, acceptance above which on a daily closing basis could initiate a fresh uptrend toward the static resistance of $2,065. Further up, the $2,070 round level will be put to the test. These are the levels that you should watch out for if you are looking to enter a long position or take some profits. On the other side, the initial demand area is seen at the previous 2-week highs of $2,041, below which the 50-day simple moving average, SMA, at $2,034 will be challenged. If gold sellers manage to find a strong foothold below the latter, the 21-day SMA at $2,025 will be next on sellers' radars. Further down, the 100-day SMA at $2,014 could offer some temporary support to gold buyers. These are the levels that you should watch out for if you are looking to enter a short position or cut some losses. Now, let's talk about the fundamental factors that are influencing the gold price. The main factor that is supporting the gold price is the expectation of an imminent Fed rate cut later this year. As you may know, lower interest rates tend to boost the demand for gold, which is a non-yielding asset, as it reduces the opportunity cost of holding it. The markets are currently pricing in just about a 20% chance that the Fed could begin easing rates in May, much lower than an over 90% chance a month ago, according to the CME Fed Watch tool. For the June meeting, the probability of a rate cut now stands at about 65%. The reason why the markets are expecting a rate cut is because of the softening of the US inflation, which is the Fed's main target. On Thursday, we saw the release of the US Personal Consumption Expenditures Price Index, PCE, index, which is the Fed's favorite inflation gauge. It was aligned with estimates of 2.8% in January but eased from December's 2.9% increase. This means that the inflation is moving closer to the Fed's 2.0% target, which gives the Fed more room to cut rates if needed. However, not all Fed officials are on board with the idea of a rate cut. Some of them have expressed hawkish views, saying that the inflation is still too high and that the economy is still strong. For example, Atlanta Fed President Raphael Bostic said the recent data shows the road back to the central bank's 2% inflation goal will be bumpy. Chicago Fed President Austin Goolsbee, also speaking Thursday, said he expects rate cuts later this year but didn't specify when. These conflicting signals from the Fed create some uncertainty and volatility in the market, which could limit the upside potential for gold. Another factor that is affecting the gold price is the risk sentiment in the market. Generally, gold is seen as a safe haven asset that benefits from risk aversion and geopolitical tensions. However, lately, we have seen a more positive mood in the market, as the coronavirus situation seems to be improving and global economic recovery is gaining momentum. This is especially evident in China, which is the world's top gold consumer. The latest data from China showed that the services and manufacturing sector activity improved in February, beating the market expectations. This indicates that the Chinese economy is bouncing back from the pandemic and that the demand for gold could increase. However, there are still some risks and challenges that could weigh on the market sentiment and boost the demand for gold. For example, the US-China trade relations, which have been strained under the Trump administration, could face some new hurdles under the Biden administration. The US has recently imposed sanctions on some Chinese officials over the alleged human rights abuses in Xinjiang, which prompted China to retaliate with its own sanctions. This could escalate into a new trade war, which could hurt the global economy and the risk appetite. Another risk factor is the rising bond yields, which reflect the expectations of higher inflation and growth in the future. Higher bond yields tend to put pressure on the gold price, as they increase the opportunity cost of holding gold and make the US dollar more attractive. The US 10-year Treasury yield has been rising steadily since the start of the year, reaching a 1-year high of 1.61% on Thursday. This could pose a challenge for the gold bulls, as they have to overcome the higher yield environment. So, to sum up, the gold price is holding steady just below a 1-month peak touched on Thursday, supported by the bets for an imminent Fed rate cut later this year. However, The upside potential is limited by the hawkish comments from some Fed officials, the prevalent risk-on environment, and the rising bond yields. The key levels to watch are $2,051 on the upside and $2,034 on the downside. The main factors to watch are the US ISM manufacturing PMI data and the end-of-the-week flows for fresh trading impetus in gold. That's all for today's video. I hope you found it informative and useful. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. Also, let me know in the comments what you think about the gold price and what are your predictions for the future. Thank you for watching and I'll see you in the next video. Bye for now.